Welcome, everyone. I am thrilled to have you here today. Let's get started on mastering the blueprint of modern corporate finance. Welcome, everyone. Today, we are diving deep into the architecture of modern corporate finance, principles of effective treasury design. As a senior treasury professional, I can tell you that a poorly designed treasury is like a leaky pipe in your financial plumbing. It drains value silently. But what exactly is treasury design? It is the deliberate organization of the treasury function, its people, and its processes to achieve efficiency, elegance, and utility. We always start with the why, which in this case is driven by our key performance indicators, or KPIs. Are we looking to lower the cost of capital, reduce turnaround times, or achieve a higher degree of control? By understanding these KPIs, we lay the foundation. You see, treasury design isn't just about picking a software system. It is a comprehensive approach that considers the legal environment, accounting practices, automation volumes, and even the competitor landscape. In this training, we will break down the what, the why, and the how of building a world-class treasury operation that truly supports the business's strategic goals and drives financial leadership. Let's take a look at the visual representation of our treasury design framework on the screen. At the very top, we have our ultimate goal, treasury leadership. This isn't achieved by accident. As you follow the flow downwards, you'll see that treasury leadership is built directly upon a solid treasury design. But what fuels this design? Notice the three critical outcome nodes: efficiency, elegance, and utility. These are our guiding stars. Branching out from the design node, we have the practical considerations that shape our strategy. You can see the KPIs node, which acts as our baseline measurement. Then we have the external and internal drivers, the legal and tax environment, and the sheer volume and growth of the business. Each of these nodes interacts with one another. If your business grows exponentially, your design must adapt to handle the new volume while maintaining strict control. By mapping these out before we even touch a bank account or a software system, we ensure our architecture is resilient, scalable, and perfectly aligned. To build an effective treasury, we must clearly define what it is we are managing. As you step into a senior treasury role, you must view your operations through three distinct, yet deeply interconnected, themes. First, transactions management. This is your operational heartbeat, the daily flow of money in and out of the firm. It covers payments, receivables, and the optimization of the cash conversion cycle. Second, balance sheet and liquidity management. This asks the question, do we have the right capital, in the right currency, at the right time? It involves funding, investment strategies, and working capital management. Finally, we have risk management. We operate in a volatile global market. Our design must protect the firm from adverse foreign exchange movements, interest rate spikes, and credit defaults. A common mistake I see is designing silos for these themes. In a world-class design, your transaction flows provide the data for your liquidity forecasts, which then inform your risk hedging models. They must breathe as a single organism. Observe the mind map before you. The corporate treasury sits at the center, acting as the brain. From it, three main arteries branch out: transactions management, balance sheet and liquidity, and risk management. Under transactions, we see nodes for payments, collections, and account management. This is the transactional supply chain. Moving to liquidity, we have working capital and funding. Notice the dotted line connecting payments and collections directly to working capital. This illustrates that efficient transaction design directly shrinks your cash conversion cycle. On the bottom right, risk management covers FX, interest rates, and credit. Look at the dotted line from funding to FX and interest rates. Whenever we structure a new funding vehicle or cross-border intercompany loan, we instantly generate a risk exposure that must be managed. This diagram visually reinforces that effective treasury design is not about isolated functions. It is about building a continuous, interactive loop of financial intelligence. Now that we know our themes, how do we actually build the infrastructure? Effective treasury design is a meticulous engineering process comprised of 8 key elements. We start with system design, choosing the right treasury management system, or TMS, and integrating it with your ERP and banking portals. But technology is useless without people and organizational structure. We must clearly define our front office for dealing, back office for settlement, and middle office for control. Next is process and control design. Every handoff between teams is an opportunity for error, so we map processes tightly to enforce segregation of duties. Then we tackle account structure and cash flow design. We do not want hundreds of idle bank accounts globally. We want streamlined cash concentration. Finally, we design our capital structure and our risk architecture. This means establishing the optimal debt-to-equity ratio and setting up the policy frameworks that dictate how we hedge. As a Treasury architect, you must balance all 8 of these elements simultaneously to ensure the machine runs flawlessly. Take a look at this block diagram representing our Treasury architecture. I've laid it out sequentially to show how one foundational element feeds into the next. In the top tier, we start with system design, which dictates the tools our people and org structure will use. Those people then execute the process design, which is strictly governed by the control design. You cannot have a secure treasury without this sequence. Moving to the second tier, our operational controls allow us to safely build our account structure, deciding where and how we hold our money globally. The account setup directly dictates our cash flow design, enabling us to pool money effectively. This pooled liquidity influences our capital structure, determining how much external debt we actually need to raise. Finally, the capital we hold feeds into our risk architecture, where we protect it all. This cascade effect shows why skipping even one design element can compromise your entire financial operation. Let's discuss one of the most powerful strategies in Treasury design: centralization. When companies expand globally, they typically start with a decentralized model. Local subsidiaries open local bank accounts, negotiate their own credit lines, and manage their own FX. While agile, this is incredibly expensive and risky. Centralization is the deliberate move to consolidate these fragmented activities into a unified hub. Why do we do this? 3 reasons: efficiency, cost reduction, and control. Imagine having surplus cash sitting in a bank account in Germany, while your subsidiary in Brazil is borrowing at high interest rates. In a decentralized setup, you suffer a massive opportunity cost. By centralizing, you gain global visibility. You can offset that deficit in Brazil with the surplus from Germany. You reduce external borrowing, minimize FX conversion spreads, and enforce uniform governance policies. The timing of this shift is critical. Usually, it happens when the pain of trapped cash and redundant bank fees outweighs the comfort of local autonomy. This diagram brilliantly contrasts the before and after states of centralization. On the left, we have the decentralized model. You see subsidiary 1, 2, and 3, each connecting to their own isolated local bank. They operate in silos. There is zero visibility across the enterprise, meaning cash is trapped and risk is unmanaged at the group level. Now, follow the transition arrows to the right side, the centralized model. Notice how subsidiary 1, 2, and 3 now route their financial requirements directly into a central node, the global treasury hub. This hub acts as the brain. It aggregates the cash positions, nets the exposures, and then interfaces with a single or a streamlined set of global banking partners. This architecture is the secret to unlocking massive cost savings. By routing through the hub, we eliminate redundant bank fees, leverage economies of scale, and gain absolute, real-time control over our global cash position. As we centralize, we must choose the right operating model. Treasury design is not one-size-fits-all. It is an evolutionary spectrum. We often begin by establishing a shared service center, or SSC. The SSC handles high-volume, low-complexity tasks. Think processing thousands of invoices for accounts payable and receivable. It creates baseline efficiency. The next step is a basic treasury center, where we centralize more complex activities like FX dealing and basic cash concentration. As maturity grows, we evolve into a value-added treasury center, or TC++. Here, treasury becomes highly strategic, managing deep analytics, long-term risk modeling, and intercompany funding. Finally, we reach the apex of treasury design, the in-house bank. In this model, subsidiaries no longer use external banks for their daily operations. They maintain virtual accounts with the corporate treasury. If subsidiary A owes subsidiary B, no actual cash leaves the company. It is merely an accounting entry in the in-house bank. This completely eliminates bank spread costs and revolutionizes liquidity. Let's walk through this state diagram, which maps the evolutionary journey of a corporate treasury. We start at the far left in the decentralized state, fragmented and costly. The first leap forward is moving to the shared service center state, driven by the automation of AP and AR. From there, we evolve into the treasury center, marked by centralizing our FX and cash management. As our technological capabilities mature, we transition into the value-added TC, where strategic hedging and advanced analytics take center stage. Finally, the ultimate state of design elegance, the in-house bank. Notice the label here mentions virtual accounts and POBO/ROBO, which stands for payments on behalf of and receivables on behalf of. This represents total centralization, where the corporate hub acts as a bank for its own subsidiaries. Understanding this progression helps you benchmark where your organization currently stands and map the precise steps required to reach the next level of operational excellence. Let's get practical and look at the actual plumbing of treasury design, account structures, and cash concentration. To optimize liquidity, we implement cash pooling. The most common form is physical pooling, specifically zero balance accounts or ZBAs. In a ZBA structure, at the end of the business day, any surplus cash in subsidiary accounts is automatically swept into a master header account. Any deficit is covered by the master account. This means subsidiaries always close at zero, and the corporate center harnesses the aggregate cash. Alternatively, we have notional pooling, where funds do not physically move, but the bank calculates interest on the net aggregate balance, ideal for countries with strict intercompany loan regulations. To implement these, we configure automated rules in our treasury management system. In a moment, I will show you a sample JSON configuration for a sweep rule. This level of technical design ensures that a company never suffers the idle cash penalty, borrowing externally at 6% while millions sit idly in another account earning nothing. Let's examine the mechanics of a zero balance account sweep using this sequence diagram. We have 4 participants: subsidiary A, subsidiary B, the master account, and our treasury system, or TMS. At the end of the day, the TMS checks the balances. It identifies that subsidiary A has a surplus of 100K, while subsidiary B has a deficit of 40K. Instantly, the automated sweep rules kick in. Subsidiary A physically sweeps its 100K surplus up to the master account, bringing its balance to zero. Simultaneously, the master account sweeps 40K down to subsidiary B to cover its deficit, also bringing it to zero. The master account now holds a net positive balance of 60K to invest overnight. Crucially, look at the final step. The TMS automatically records the intercompany loan between the master and the subsidiaries. For those configuring this in a TMS, your backend rule might look like a simple JSON snippet: rule type, ZBA sweep, source, SUBA, target, master, trigger, EOD, retain amount, 0. This is how modern treasury automation is executed. Let's apply everything we've learned to a real-time use case. Let's look at the Global Growing Group, or GGG. GGG experienced explosive growth, expanding rapidly into 50 countries. However, this growth was unchannelized. Each local subsidiary opened its own bank accounts and managed its own liquidity. The result? A massive spike in operational costs, zero visibility into global cash, and immense, unmanaged FX risk. The CFO realized they were bleeding value. Our solution was a comprehensive treasury redesign. We architected a migration from a totally decentralized setup to a value-added treasury center, a TC++, supported by a shared service center for payables and receivables. We rationalized their banking structure, moving from dozens of local banks to a few strategic global partners. We implemented ZBA sweeps to concentrate cash centrally and introduced multilateral netting to reduce the sheer volume of cross-border FX transactions. The result was transformative. GGG drastically reduced their external borrowing by utilizing internal liquidity, slashed their FX conversion costs, and gained real-time control over their global risk. This flowchart maps the dramatic turnaround of the Global Growing Group. Look at the top section, GGG before. It was a crisis state. They were dealing with 50+ local banks, which led directly to the trapped cash node. Because they had no central TMS, they suffered from blind FX risk. And because subsidiaries couldn't share cash, they engaged in local borrowing, driving up high interest costs. Now, follow the redesign arrow down to the GGG after state. By applying the principles of treasury design, we implemented bank rationalization, which allowed us to create ZBA cash pools. We deployed global TMS integration, enabling real-time risk hedging. Notice how both the cash pools and the risk hedging feed directly into the final node, internal funding. By architecting this TC++ model, GGG stopped borrowing expensively from the outside and started funding itself from the inside. This is the profound, real-world impact of expert treasury design. As we conclude our training, it is vital to understand that treasury design is not a set-it-and-forget-it project. It is a living, breathing architecture. To sustain this design, you must continuously evaluate your operations against your KPIs. Are your cash pools still efficient? Are your hedging strategies protecting the balance sheet? But beyond systems and processes, the true glue that holds an effective treasury together is the treasury culture. You must foster a mindset within your team that values strict control, proactive risk mitigation, and technological fluency. A well-designed treasury and a strong culture act as the ultimate shock absorber for a corporation when market volatility strikes or liquidity dries up. By mastering these principles, you elevate treasury from a reactive back-office function into the predictive, strategic brain of the enterprise. Thank you for joining me today. I invite learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Let's review our final diagram, the life cycle of treasury sustainability. This state diagram shows a continuous, infinite loop. We begin at design, which flows into implement, where we apply our technology and processes. From there, we move to measure, tracking our results against our KPIs. The insights from measurement drive us to refine, where we stress test our models and adapt to new market realities. This refinement feeds right back into a new phase of design. But notice the substate box at the bottom labeled culture. The measure phase directly impacts our culture. Within this cultural framework, strict control provides the foundation for operational agility. That agility eventually matures into strategic foresight. This visual encapsulates our entire philosophy. Great treasury design is a perpetual engine of improvement, driven by data and sustained by an empowered, forward-thinking team. Thank you for your time, and keep building excellence.